Okay. Thank you for joining us this evening. We're excited to present the fifth in a series of 6 webinars with the fun theme of Your Doctor Now What? This series is being brought to you by the National Medical Health Collaborative, which is a nonprofit entity established by the Missouri State Medical Society, the Arizona Medical Association, and the Wisconsin Medical Society. The collaborative has a mission to promote and advance the healthcare field by providing education, policy development, and resources aimed at improving the delivery of patient care. My name is Libby McDaniel. I'm the CEO of the Arizona Medical Association, and I will be your moderator tonight. Tonight's webinar will be focused on the important topic of investing and retirement 101. And I'm pleased to introduce our speaker tonight, Mike Carpenter. Let me stop sharing my screen. Mike is presenting on the topic of investing and retirement 101. He's a partner in Moneta Company, and he has both his Master's of Accountancy and his JD degree. At Moneta, Mike and his team handle a wide variety of financial issues for clients with the goal of helping them achieve their financial objectives. When he's not working, he loves to play golf and travel with his family. We hope you enjoy tonight's webinar. You will receive the slides in follow-up and a link to the presentation. And with that, I'm going to hand it over to Mike. We're excited to hear about investing in retirement.
Thanks, Libby. Appreciate it. All right, I'm going to share my screen here. I've got some slides to see if something to look at while I'm talking. Libby, I think that's good, but let me know if not. You all should be able to see my screen now. So again, the topic of tonight really is investing in retirement 101. And we titled this presentation, How to Maximize the Opportunity Cost Game. We tried to keep it higher level, more practical considerations, although we do have a little bit of detail as far as types of investments and all that. But anyway, the more practical type consideration, we felt that you might find more value in that. So maximizing the opportunity cost game is the topic or the title. You know, we're hoping that you could get a little bit out of it more than just the details. So the 4 concepts are listed below that we'll talk about tonight. Financial planning, we'll go through a handful of concepts, higher level type items that we think that any investor should take a look at, particularly young folks as they build their nest eggs or start to build their nest eggs. Investing concepts and things that you all should consider. Types of investments, I'll try not to get too in the weeds or in the details there. But we do have a little bit of that for you. And then other types of planning items that, again, we think that everyone should consider, okay? So as we talk about financial planning concepts, what is opportunity cost? I thought we should probably define that first. We look at as the loss of a potential gain from other alternatives when one alternative is chosen. In other words, by choosing one route or another, what are you giving up by not going the other route, okay? And so this, the cartoon here shows, again, what's the opportunity cost? The birds could go into and get the free lunch, so to speak, but they might be giving something up. The opportunity cost by going after that food in the box there would be freedom, right? So again, you have lots of different types of resources, everybody does. Most of your human capital resources, your time and energy, is probably spent at the office and in your practice. And what are the ways that you can structure your retirement and savings program to take advantage of and get it working for you, basically? Okay, so that's kind of the goal here tonight. Probably the most important consideration that I could share with you tonight, and you probably all know about it already, but it's the power of compounding. And so what we would tell folks is, the earlier you can start, the better off you're going to be. And we have an example here that kind of quantifies what that is. In this case, we have Stephanie and Aaron. They both are the same age and the same financial situation. They both earn about the same per year. Stephanie starts saving 10% of her income for 40 years. So she starts 15 years earlier than Aaron. He waits 15 years before starting to save. But if Aaron wants to catch up after the 15 years that he waits, he has to save about 3 times his income at that point to catch up to where Stephanie is, okay? So basically what that ends up costing him is about $100,000 more in total contributions to his retirement plan. Again, The power of compounding. It's very, very strong. So getting your money to work, putting it to work early, and letting it earn interest and dividends and growth. Okay, and then the next slide is, I know this is kind of hard to read. There's a lot of numbers here, but these are all the numbers that back up the previous slide. So it gives you your example. And if you see in the far right side there, you see lifetime contributions. Aaron's in the green and Stephanie's in the purple. So in this example, she saved $140,000, contributed $140,000, and he had to do $246,000. Okay, so that's where, in order to get up to where she ends up, he has to save a lot more. Okay, save early, save often. That's probably the most important thing we can share with you tonight. Some other pieces of information that we think you all should consider. At some point when you're in private practice or in practice right now working with a company or a hospital, whatever the case may be, or if you're soon going to be, most employers provide access for their employees to a retirement plan. Those could be 401ks. If you're in the nonprofit sector, those could be 403bs. There's a handful of other types of retirement plans like simple IRAs and things like that. SEP IRAs, maybe if you're self-employed. But our recommendation would be participate, particularly if your employer offers a match. And what a match is, it's a way that companies can entice people to save their own money, and by doing so, they'll contribute on your behalf to match your contributions. So kind of a run-of-the-mill typical type match that most will see, and it'll vary depending upon the company you work with and the plan that they have in place. But a general run-of-the-mill one that you might see is 50% of the first 6, which means if I'm an employee, if I contribute 6% of my pay into the retirement plan, then my employer will contribute 50% of the 6, or 3%. So in that regard, I contribute 6, my employer contributes 3, so I get a total of 9%. And the 3%, if you're talking about investment returns, that's 100%. You put some money in, they give you the match, the 3%. That's 100% return on your money. Okay, it takes many, many years, sometimes decades, to get that type of a return on your investment. So that's just free money. They're just giving it to you. So our recommendation is take it, please. Okay. Beyond your employer provided retirement plan, we would recommend you then start, if you have excess monies that you want to start contributing and saving for retirement, again, back to the save early, save often, to the best that you can, utilize tax preferred investment vehicles, okay, and investments as well, okay. So we'll get into the investment part. This slide just shows the types of vehicles that we recommend you look at or consider, okay. So beyond your 401k or 403b, you might have the ability, and everybody does outside the 401k or 403b, the ability to contribute to an IRA, okay. And then we put 2 different types of IRAs or 401k, 403bs. There's traditional and there's a Roth, okay. And a traditional IRA or 401k, 403b, the contributions go in tax deferred, meaning you get a tax deduction up front. In essence, you don't pay tax on the contributions. They grow tax deferred, and you don't have to start paying tax on the monies, income tax on the monies, until you start withdrawing. In many cases, that's later in life, and at the very latest, under the current rules, it's age 72. So you put the money in, let's say you're 30 years old, you put the money in, it comes out of your paycheck, goes into the 401k, you don't pay tax on it now. You can let that grow deferred of tax until you start withdrawing. Let's say you start withdrawing at age 72. So you've had 42 years of tax deferred growth within that contribution. On the other side of the coin is the Roth IRA, and it's the exact opposite. So you pay tax up front on the contributions, but then you don't pay tax as they grow, and you don't pay tax as you withdraw, you withdraw from the account, okay? So and again, there's a lot of different factors that go into, and I'm sure that's going to be a question that you all have. Should I use traditional contributions or should I use Roth? And there's a lot of different factors that go into that, but very generally speaking, if you're under the age of 40, yeah, you should probably be considering the Roth IRA, because while you may be paying a higher percentage as far as income tax goes on the Roth contribution. Now you get so many years of tax-free growth and tax-free withdrawals that it overcomes the cost of upfront of paying those taxes now. So in the upper right-hand corner there, you can see the Roth IRA tree, which shows that that after many years of growth, you see that tree grew pretty tall, and it produced a lot of fruit. And the farmer, the person who planted the tree, says, and I only had to pay tax on the seed. That's a perfect depiction of what a Roth IRA is. Okay, so and another thing to consider is, if you want to do both, that's not necessarily a bad idea. Using some monies and contributing on a traditional basis, some on a Roth basis. In that regard, you would have what I would consider tax diversification. So it'll allow you later in life to choose from which account to pull from as you manage your tax consequences. Okay. For those with young children, you should be considering 529 accounts. Each state has their own plan. Missouri's is called the MOST plan, but we included the details for Arizona and Wisconsin as well. And so you can see that you get a tax deduction up front. The monies grow tax deferred, and if you use them for quote unquote qualified education expenses, there is no income tax that you pay on it. Okay, it's a beautiful thing, particularly just like we're recommending you start early and save often. We do the same for your kids. That would be our recommendation. Okay, I would note the differences between if you're a Missouri resident, right? The 8,000 if you're single, if you're filing jointly, if you're married, you can contribute up to 16,000. So in Missouri, that's about a $800 income tax savings. Okay, in Arizona and Wisconsin, it's different a little bit, in that the amount that can be contributed each year for purposes of the state tax deduction is based upon the beneficiary. So if you have 4 children and you live in Arizona, you can do 4 times, if you're single, you can do 4 times the 2,000, so 8,000. If you're married, you can do 4 times the 4,000, one for each of the 4 children, to 16,000. And the same is the case with Wisconsin. It's based upon the beneficiary. In Missouri, it's based upon the contributor. So you can't do more than 8,000 if you're individual, and 16,000 if you're married filing jointly. Okay. A quick note about the qualified education expenses. The definition of that is pretty widely defined these days, but very generally speaking, it's anything that a typical student would require: books, computers, room and board, things like that. So you can dig into the details and look them up online, but the definition of qualified education expense is pretty expansive today. Okay. Actually, they had changed the rules over the years too, and you can use those. It used to be only for college and after high school type educational expenses. Now you can use it for tuition from kindergarten through 12th grade as well. Okay. The other type of accounts that we think you should consider look at are more health type accounts, the health savings account and the flexible spending accounts. Okay. And so you may have access to these through your employers. The difference between the two, the health savings account, is that the account any balance at the end of the year rolls over from one year to the next. And so in that regard, you can save a lot more and it can grow over the years. The flexible spending account, however, is capped at, you have to basically spend it each year. The rules change a little bit. You can roll, I think, a $500 or so balance over, but you pretty much have to use it or lose it in the flexible spending accounts. Okay. Another difference is the health savings account. To be eligible for it, you have to be enrolled in a high deductible healthcare plan. Okay, so that, again, those are some additional tax preferred ways of savings, in this case for healthcare expenses. Okay. All right. Getting into investing, kind of higher level again type concepts. Risk tolerance is a pretty important thing to consider. Okay, and everybody's going to be different. Risk tolerance is just the extent to which an investor is willing to accept risk in pursuit of a financial reward. So you probably have all heard about this. The more risk that you're willing to take, the higher the return. Or conversely, if you're unwilling to take a lot of risk, you probably can't command a whole lot of return for that type of an investment. Okay. This is a very, very important thing for everyone to consider for themselves. And it also bleeds into the topic of asset allocation, okay, which is just a fancy way of saying what percentage of your assets are invested in longer term growth type investments and what percentage of your long-term plan in your investment portfolio is allocated towards more shorter term fixed income type investments. Okay, that's all asset allocation is. There was a study that was done back in the early 90s, and it would hold true today, that implies that 91%, so over 90% of every return you get going forward in the future is going to be based upon the asset allocation decision alone. Some other determinants of the return for your portfolio are listed here as well. Security selection makes up about 4%, this study found. Market timing is about 2.8%, and then other factors a little over 1%. So what this implies is you shouldn't really focus your time on things like security selection. So do you buy Pepsi or Coca-Cola or Johnson & Johnson or Microsoft? Certainly that matters, but it matters very marginally relative to the asset allocation decision, right? What percentage is in long-term growth investments and what percentage is in fixed income? That is where you get the most bang for your buck. The other thing that you'll see on here is most people have a tendency to focus on market timing, which just means when to get money, put money into the market and when to pull it out. Okay, most people think that they're smart enough to figure out the best time to do that. I would tell you that that's just not a very good long-term strategy. And this study backs that up. Okay, so focus on asset allocation. Once you figure that out for yourself and for your family, stick with it and don't change it unless something significant like your life circumstance changes or your goals or something like that. Stick with it and reassess every year or two whether that asset allocation, that risk tolerance still remains appropriate for your needs. Okay. Bleeding into the risk and the risk reward and asset allocation discussion, we put a chart in here to show you kind of over longer periods of time, and this is over the last 50 years, how has that asset allocation decision played out for investors? Okay, so if you are someone that says, I'm very risk averse, I'm not willing to take a whole lot of risk, you're going to be down at the bottom of this chart. And so you want to be 100% fixed income. Okay, but you can see by doing that, there's a consequence in every decision you make. So if you say, I'm not willing to accept a whole lot of volatility or risk, I want 100% fixed income, that's fine, but you have to understand what that means for the portfolio. Okay, so the average annual return for a portfolio like that is 6.5%. You might say, great, and that's okay. I'm okay to accept that. The single largest one-year gain is 27%. Single largest one-year loss is 4.7. Not too bad. I mean, only the worst down year in a 100% fixed income portfolio is 4.7%. Today, it's a tough year for 2022. If you look at this chart, that actually would be a bigger loss. Bonds on average are down greater than 10% this year, just as a side note. Okay, but again, sticking with the 100% fixed income, very conservative allocation, the number of positive years are 45, the number of negative years are 5. So you might say, that's not so bad. Compare that to the riskiest, I guess I probably shouldn't say that, but the most equity-oriented allocation, which is 100% equities, you can see your average annual return over the last 50 years was over 11%. The single largest one-year gain was 41%, and the single largest one-year loss was 37%. You had 41 positive years and 9 negative years. So when you're trying to figure out this allocation decision for yourself, I have partners that use a chart like this, and they start at the bottom and they cover it up and they uncover it as they go, and they say, okay, tell me when your ulcer hurts. And so it's just a way to assess how risky you're willing to be, okay, how much risk you're willing to accept for the returns, and that's the average annual return column there. Okay, so you can see how that would have impacted you. And again, nobody knows what the future holds, but if you believe that history is a good guide, then this is a good chart to use as you assess your risk tolerance. Okay. Diversification. One of the other items that we typically tell clients and investors is diversify your monies. And all that means is spreading the risk over lots of different types of investments, over different companies, over different time periods. Okay. And what is diversification? And Warren Buffett says it best: it's protection against ignorance. And so what you're doing is you're trying to invest your money over lots of different types of investments. Okay, so you don't want to buy necessarily 100%. Don't want to put all your money, all your eggs in one basket. Okay, because there is, even though you may think that that company or that investment is the strongest or best company or investment ever, the reality is that every investment has its day in the sun, and it has some days in the rain as well. So you want to diversify, because diversification protects against the risk that you guess wrong. Okay. And so we typically tell clients that, how do you know when your portfolio is diversified? And the answer is because you're always going to be disappointed with the current performance of at least a portion of it. Okay. So you're not trying to get rich real quick. You're trying to spread your risk, and you're doing that to protect the downside, basically. Okay. And this chart is a pretty good chart to show you, why do you diversify? As you can see, the colors down below, the grid there shows you which investments performed the best in any given year. And this goes back to 2011. So you can see there's really no discernible pattern here. Certainly nothing to say you should put all your money in one asset class or one category, because, you know, one year they may do the best, and then the next year they may not do as well. And so again, diversification. So we want you to pick a risk tolerance that's appropriate for you. That bleeds into what's your asset allocation. And then you diversify your monies. And then over time, as the markets inevitably change, we would tell you that periodically you should look at rebalancing your portfolio. And all that means is that you sell things that have done well to buy things that haven't done quite as well. Okay. And all that does is it's a dedicated strategy to force you to buy low and sell high. So in this chart at the bottom here, it shows you how a typical rebalancing would work. So if you have, very simplistically, let's say you own 4 asset classes and you allocate 1/4 each to each of the asset classes. Over periods of time, you see that markets move, and you can see in period 3 here, what was previously a 25% to each of the 4 categories. Now you have one category that grew to 34% of the portfolio, and one that grew to 31%. And in conjunction with that, the other 2 categories shrunk a little bit as a percentage of the overall portfolio. So what a rebalancing would do is, in period 3, it would say you should sell a few percentage points of asset class 3, which is the green section there, and you should sell a few percentage points of the asset class 4, the yellow, and you should reallocate to bring the blue and the red back to the 25% stated targets. Okay, so that's typically how rebalancing works. Okay, we typically get a question of, should we put, if we have a lump sum of money, should we put it all to work immediately, or should we dollar cost average and filter the money in over periods of time? And so these charts show you what each of them are. So in the green, if you believe in dollar cost averaging, it says that if you have $1,200, you should invest $100 a month for 12 months. Okay, by doing that, you'll get some investments that time them perfectly, and some you probably won't. But you will kind of average and smooth out the returns over a period of time. As opposed to lump sum investing is, it would put all the $1,200 to work immediately. There's been lots of studies to show what's the best way to do it. The answer really is that dollar cost averaging doesn't seem to improve your returns, but what it does do is it helps you manage the psychology of putting the money to work. So if you're a lump sum investor and you put in this case, the $1,200 to work immediately, and there's a terrorist attack or something the next day, and the markets very well could be down 20% in that scenario, then you will have lost a significant chunk of money. And so again, if you're a longer term investor, theoretically you'll ride through that storm. However, some people just can't handle the psyche of knowing that they put the money to work and they lost 20% immediately, or at least they'll think that. And so if you're that type of person, dollar cost averaging helps you through that psyche. Okay. The 5 core tenets of successful investing are on this slide. We've talked about a few of these already. So diversification, we talked about that. Disciplined rebalancing, and then be resistant to panic and euphoria. We have a chart on the next slide that we'll go through that. But basically, don't think when things are good, don't necessarily think that they're never going to be bad again. And when things are bad, don't believe that they'll never turn around and things will never get good again. But we have a chart. We'll get to that here on the next slide. But the other two, numbers 4 and 5, focus on the things that you can control. You cannot control whether the markets go up or go down. You can control the investments that you select and the fees and expenses that you pay as a result of that decision. You can control that. Number 5, you can also control your spending and your savings. I mean, those things, two things work together, right? So the more you spend, the less you save. The more you save, the less you spend. So focus on the things that you can control. The other things, they're out of your hands, so don't focus too much on it. Okay. Back to the euphoria and panic. We have a chart here to show you the cycle of market emotions. And so it shows you from optimism up to euphoria, and then from euphoria down to depression and back up to optimism. Generally speaking, if history is any guide, markets tend to cycle through. So there will be periods of time that things feel really, really good. That's the kind of euphoria phase. There are times when the market and things feel very, very bad. That's in the panic and capitulation and depression phase. And stepping back and figuring out where you are in the cycle will be very helpful as you invest your monies over longer periods of time. But I think this chart shows me more than anything, just acknowledge that these things are going to happen, and your psychology is going to be tested as you invest your monies. And the longer your time horizon, the easier these things are to kind of get over, I guess. And so don't get caught up in the moment, I guess is what I'm saying. Keep a long-term perspective and save early and save often, and just put as much money to work as you can over time. I think by doing that, I think you'll take the human element out of it. And I think longer term, you'll be better off if you do that. Okay. Types of investments. So stocks are the ones that most people think of. Again, these are equity investments. If you are a stockholder, you are entitled to a share of the profits. Typically, those profits are shared or are distributed to the shareholders as dividends. Oftentimes, those are paid out on a quarterly basis. Okay. On the other side of that coin, however, as a stockholder, an equity holder, if you invest in a company that falls on hard times and goes under, then you're also the one that's standing last in line. Okay, and so all the debts have to be paid before you would receive a recovery. Okay, because of that, there's those types of investments, equity investments, are generally more volatile. Okay, now over longer periods of time, historically they've had higher returns too. So again, this goes back to the risk return scenario. Okay, liquidity, we put that in there. That's again, I think everybody probably has heard about the stock market or maybe even is involved in the stock market. Typically, liquidity for typical stocks is more than likely okay. Again, it depends on the size, the market cap of the type of investment that you're in. More often than not, you're not going to have any trouble getting out or selling the investment. The smaller you go, the smaller companies may not be as liquid. And so you just need to consider that as you invest your money. Okay. And again, back to the price of the stock fluctuates really on a daily basis. So you just need to be willing to stomach, and they're a lot more volatile than bonds or fixed income, which is listed on this slide. And a bond is really like an IOU. So you loan some entity, a company, a municipality, a government, you loan them money. And in exchange for that, they promise to pay you a stated rate. Okay, that's your interest rate. And so let's say you buy a 10-year government bond, you are loaning the money to the government for 10 years. They pay you interest for those 10 years. At the end of the 10 years, they give you your money back. Okay. Typically, though, and it depends on the type of bond or CD. Typically, bonds are paid, interest payments are made twice a year. Some CDs are paid every month. So just so you know about those. Okay. Excuse me. Typically, bonds are less volatile than equities on the previous slide. And again, going back to the asset allocation, you want probably for most people, the answer is going to be a mix of both, some in equity investments and some in fixed income. Okay. And again, liquidity, typically it depends on the type of investment. Again, the liquidity does, but the bond market is even bigger than the stock market. So typically you're not going to have any trouble getting out of most fixed income, tried and true municipal bonds, CDs, things like that. Okay. Mutual funds, which also goes along with exchange traded funds, are typically a basket of securities, and they're it depends on, you can get both equity mutual funds and you can also get fixed income mutual funds. Okay. And so it's just a basket of securities that is managed by a professional manager. And it depends on the type of fund that you buy, but you can pick and choose whether you want a bond fund or you want an equity fund. Exchange traded funds are very similar to mutual funds, except there's a mechanism that allows them to be tax efficient. So you've probably heard of most ETFs, but iShares are one, Spiders, SPDR. So again, it's just generally buying the market in a very low cost fashion and also a tax efficient manner. Okay. So the things you want to focus on there, again, these investments, mutual funds and ETFs are beautiful for the diversification perspective, because it diversifies your money over lots of different, sometimes hundreds of different names or investments. They are managed professionally, so you're kind of outsourcing that professional management or your time to let someone else do it for you. And then you want to focus on the fees. Again, back to my comment about focusing on the things that you can control. Management fee. So each fund or ETF will have a management fee. That's the hidden fee that you pay for those people, those managers, to manage your money. Typically, mutual funds are actively traded, and those tend to have higher management fees. The ETFs, generally speaking, don't require as much maintenance, and in that regard, the fees are lower as well. That's not always the case, but that's typically the case. And so, as you invest your money in a mutual fund or an ETF, just be knowledgeable about the fees that you're paying by those folks managing your money. Okay. Other planning items. So just kind of, these are the check the box type items. So we want to make sure that everyone's estate plan is up to date. And again, certainly if you're working with an attorney, you should talk with him or her to figure out what's the most appropriate documents for your needs. But generally speaking, most folks, we would say, need 3 documents: the last will and testament, power of attorney, one for finances and one for healthcare. They do different things. And so you want to make sure, again, those are the documents that step in to make decisions on your behalf if you're unable to do so. A last will and testament is also important. Not only does it share how your monies and your assets are going to be split at your passing, but if you have young children, it says who's going to be taking care of them if I'm not around. Okay. Revocable trust or trusts may make some sense. Again, talk to your estate planning attorney to see if that makes some sense. But those are typically the documents that we would talk with each client or investor and make sure that they at least considered having those documents. Okay. Insurance. So as physicians, I'm sure if you haven't already, you'll be contacted by just about every type of insurance agent there is. And make sure that you have appropriate insurance, adequate coverage, and try to keep your costs, your premium downs as much as you can. Okay. So again, typical insurance that you should look at: malpractice, property and casualty. So these are your auto and homeowners insurance, life insurance, and I put in there careful with annuities. Annuities typically have very high costs and don't necessarily accomplish what most people are trying to accomplish. We always say that annuities are sold, they're not invested in. So again, just be careful. Disability insurance. So if something happens to you and you're unable to continue at your job as a physician, what type of coverage would you retain there? Long-term care, typically later in life, again, we tell folks as they approach retirement, they should look at long-term care, not necessarily buying it. It's pretty costly today, but you should at least consider it and see if that's part of your long-term plan. And then umbrella coverage as well. So an umbrella coverage, personal liability, it lays over like an umbrella over the typical property and casualty, auto, homeowners, and things like that. Okay. Lastly, we put in there just a reminder for folks that typically the unclaimed property kind of goes unnoticed. And so with each state, there's a website that you can go and figure out, do you or any of your friends or family members have any unclaimed property? Most folks forget about these, but it is good to check periodically just to make sure. You'd be surprised what you find out there. A lot of times it's things like you had a life insurance policy that the company demutualized and you got some shares and you kind of forgot about them, didn't transfer them or whatever the case may be. That's a lot of times what we see. Small bank accounts that just go unused for a period of time, they revert back to the state in those cases. So again, just check in and make sure that you don't have anything on there. Your parents, grandparents, siblings, friends, just make sure that you don't have any unclaimed property. Usually, if you do, it's usually not for much, but we have found some pretty large claims there for clients. But usually, there's an online process that you can claim those properties pretty easily. Okay. So that is all I had. I guess, Libby, should we open it up for any questions?
That would be great. Mike, thank you so much. Such a comprehensive and informative presentation. Really, really valuable stuff. We appreciate your time tonight.
Sure.
So yes, we are going to transition now to the Q&A portion of our webinar. For those folks that are on the line, please feel free to submit your questions via the chat feature or via the Q&A button, and Mike will be happy to answer them. And we've had a couple of questions come in throughout the presentation, so we will start with those. Mike, you mentioned in part of your presentation that diversification is key as we think about asset allocation. You specifically mentioned bonds, stocks, and mutual funds. What is your philosophy on investing in crypto?
Crypto is crypto is a challenging space right now because it is a new asset class it's just starting to get its feet underneath it. There's a lot of volatility there. So when you talk about risk reward, it is among the more risky types of investments that you could get in. There are challenges with holding it. Do you hold it, hold your own key or whatever the case may be, or do you hold it in like a PayPal account or account like that? So I'm not a huge fan of crypto, only because I think that that asset class in general it's still going through price discovery, and in that period of time there can be a lot of volatility. And the other thing is you have to really understand what it is, in my opinion, before you're going to put your money into it. And so there's a lot of information out there. I would tell you to do your due diligence and your research before you put your money in there, because I think we've run into and seen scenarios where just recently where people had money in crypto that they didn't necessarily know what they owned. And in some cases that money went away pretty quickly. So I would just say be very careful. I'm not saying don't do it. I mean, it's in theory a very long-term type strategy that hedges kind of what the U.S. government is doing. But I would just say be very careful.
So it's definitely riskier, is what I'm hearing.
Definitely riskier. I mean, again, and over time that may settle down and that may work itself out, but so far it's been very risky.
Thank you. Okay, the next question. We know the markets are cyclical, and this year we've seen a down market. I think you mentioned down roughly 10%. Should the market, what the market is doing, ever dictate your investment philosophy or asset allocation as an investor? Great
question. No. Again, that's why you want to focus on the asset allocation. Some of the concepts that I talked about tonight is asset allocation and then rebalancing. Okay, and so once you figure out that asset allocation, I would not let the markets dictate it, because again, that's the human psychology getting involved. Okay, and so if you have the right asset allocation for your needs, for your long-term plan, then the markets really shouldn't play a role in that, right? You're making these long-term decisions based upon what you want to achieve, how long you have, and things like that. So, the rebalancing is what comes into play in a year like this. And so in theory, you're selling things that didn't do as well, and you're buying things, I'm sorry, selling things that did do a little bit better, buying things that didn't do quite as well. So in a year like this, yeah, I mean, you're probably selling bonds or using some of the cash that you have to add to equities. And again, back to a comment I think I made on here, if you're a long-term investor, think about it. The human psychology of it is such that I understand that humans are humans, and so we're wired this way. But if you think about it, if you're a long-term investor, you shouldn't really care about what the market is doing. In fact, you could argue that you should want the market to go down and down and down, because as an accumulator, all you're doing is purchasing and acquiring units. So in theory, you should want to pay less for those units, right? Just like when you go to the store. If you're buying things, you'd rather pay things at a 10% discount than you would at full price, right? So in theory, you want, as an accumulator, you want the market to go down and down and down. And then the day that you retire, as you're accumulating units, and then the day you retire, you want to shoot right back up. Of course, it doesn't work that way always. But no, I would not let the market dictate my asset allocation decision. And in fact, that's why you have that decision. Figure out what's most appropriate for you and for your long-term plan. And then when the markets move, and they will, use the rebalancing feature to get back to those long-term targets that you've found for yourself.
Thank you. The next question, we all know that physicians are experts in their field and investment advisors are experts in yours. And so we want to make sure that we're utilizing experts to help manage our money. But for folks that don't have investment advisors right now, what questions would you suggest they start with as they think about, partnering with an advisor in the future? What are some good questions to ask?
As far as an advisor goes, you mean?
Yes.
Yeah, so I would make sure that you find someone that you're comfortable with, that has the same interests, they're aligned with your interests, and they're paid on advice that they give you that is commensurate or in alignment with your goals and objectives. Okay, so typically what that means is some sort of an independent registered investment advisor is really what, and that's what we are. So I'm not making a plug for us, but we get paid as our clients' assets go up. Right, and we don't get paid on anything else. So we didn't get paid commissions or anything like that. So in that way, our interests are aligned with our clients, because at the end of the day, if you're working with an advisor that gets paid commissions on transactions, how do you truly know that the advice that they're given or the investment that they're putting you in is best for you or best for them? And now, again, I'm not to imply that there's bad people out there, although there are, but the reality is everybody's human. If I'm paid on a commission on a transaction, I'm only human. I'm going to put you in the things that pay me the most. That's just how humans are. So I would find an advisor that has their interests are aligned with yours. I would also focus on, excuse me, on an advisor that is held to a higher standard. So in our industry, there's two types of standards. There's a fiduciary standard, and there is a best interest suitability standard, basically. So if I'm held to a fiduciary standard, legally, before I can talk with anyone about any investment, I need to figure out who they are, what they're doing, what's their long-term objective, what are the fees and costs and things in every investment that we're recommending. If you're held to a suitability standard, it's more along the lines of, if you're Joe, 40 years old, what's a suitable investment for any 40-year-old kind of like Joe? So it's a lot lower standard. So the fiduciary standard, which is a legal liability, a legal standard, I would focus on that as well.
Thank you. Thank you again. If there are any other questions, please feel free to submit them. In the meantime, I'm going to share my screen momentarily and pull up our last slide here, which is really just a thank you. A thank you to Mike Carpenter for presenting on this very important topic tonight. And a thank you to all of our participants. We greatly value everyone's time. We hope this information is valuable and useful to you. I'm going to give everyone the gift back of time, roughly 10 minutes before the hour. Again, thank you so much. We hope you enjoy the rest of your weekend and have a great evening. Thank you. Take care.
Thank you.